All right. So again, welcome everyone to the Tasty Trade Know Your Risk demo. We're going to be going over a lot here on the platform. We're going to be going over how to set up your positions page and your account header detail to just when you open the account, you're going to see your different risks in the account. And then we're going to go over each position risk that you have, going over how to analyze that. Then we're going to take a look at overall portfolio risk as well. That's where we'll spend most of our time on our super interesting risk analysis tab. And then we'll just talk about some general risks that we see in the account, expiration risk, early assignment, and then just, managing risk in your overall portfolio. And then once that ends, we'll go to question and answer Q&A from us, Q&A. Quentin and Anthony, how cool is that? Q&A with Q&A. And then, yeah, so let's get started. A lot of people ask when we're talking about risk, how do we manage our risk and what metrics do we look at? So when it comes to trading, understanding your risk is just as important as finding all of these opportunities. And every position carries exposure, whether it's defined or undefined. And then knowing how to measure that exposure is what keeps you in the game long term. So in this demo, we're going to break down the different types of risk that traders face. We're going to break down the different types of risk, how to stay in the game, and how to see them on the platform, and how all of that impacts your portfolio. So, Anthony, what do you say? Let's get into it. Want to talk about the different position columns that we can add?
Absolutely here. So with these different position columns here, a couple important ones to note on the positions page here will be your delta column. So to go ahead and add that to your positions tab, if you go ahead and select the gear icon off to the right side of the page here. So you all should be able to see this gear icon. Go ahead and select that for me. This will pull up our settings menu. Now, from the settings menu here, if you choose accounts from the modules, and then you'll choose positions here, the positions tab at the top, you'll see two different columns here. We have displayed and not displayed. What we're looking for here, especially if you're paying attention to the Greeks, a couple of the important ones that we already have added would be net delta, and then we also have our net theta here as well. So if you don't currently have those added, just go ahead and click and drag those over to the displayed column. Once you've done so, you can go ahead and click OK. And then now on the positions tab here, you'll see we have our net delta and our net theta.
And then so when we're looking at the overall account, you'll want to look at the delta, theta, and vega for your overall account and the metrics there. And this will take into account all of your positions. In terms of the delta, will be beta weighted to SPY. And then your theta, just your overall account's time decay. And then the vega that you have in the account as well, your exposure to volatility. And then to add this, you can go to the settings, the same place we just went. And then here, you'll just want to click on header detail. And then you can have the displayed and not displayed columns. And then here's where you want to enter your delta, theta, and vega, and then anything else that you would like to see at the header of the account when you first walk into the account, when you log in. And then another thing that we can also take a look at is the ETF delta if you're trading futures. This is what we call a little ETF triangle, just because that's how it looks. You'll want to make sure if you're trading futures that you have show futures delta using equivalent ETF or stock symbol. And this can be found in the settings as well. The reason we want to look at this, if you're trading something like /ES, that will relate your deltas to SPY. If you're trading something like /GC, that will relate your deltas to GLD, and it will just make a lot more sense when looking at the overall positions page. And so always make sure you have that highlighted if it doesn't come automatically pre-populated with the positions tab on the account.
Another thing to note here with that ETF delta, especially if you're a futures trader, again, like Quentin had mentioned here, that is going to relate or correlate your deltas to SPY. So if you're looking to possibly hedge some futures positions using shares of SPY, that would be one instance where you'd like to use that ETF delta.
Yes, yeah, exactly. And so now that we've gone over how to set up your platform to be able to view the different Greeks in your account, now we can talk about position by position risk. And so to view that, here we'll just click on SPY just to make that the active trading symbol. And then on the left-hand side, we'll want to click on trade. And then from here, we'll want to change the trade mode from table to curve. And then make sure to have analysis selected as well. And this will pull up our analysis page. And then, Anthony, do you want to talk about what's here to view on the analysis?
So in this case, with the analysis tab here, I always like to start with what is it exactly that we're looking at. So you all, if you're not familiar, you need to know we have two different things that you can do on this analysis mode. You can view your profit and loss zones at expiration. You could also view your theoretical profit and loss zones. So to set those up now, we'll just go through a little setup here. With the profit and loss zones at expiration, it's very important that you have two particular buttons selected. So it's going to be this P&L Theo, or I'm sorry, P&L EXP. And then under zones, you select at EXP or at expiration. So we'll just go ahead and deselect Theo right now. We have no Greek, so just a very vanilla setup right now. So this is just strictly your profit and loss zones at expiration. And as you're hovering your cursor along the graph here, you can see we get this neat little information box where we have some information regarding the date, the current price of the underlying, and the profit and loss at expiration. So as we hover our cursor along to the right side of the graph here, you can see what this is telling us now. Under price, it's showing if SPY were to be trading at a price of 664.89 come expiration, our profit and loss will be $36. Now to touch a little bit on the P&L Theo buttons here. So we'll go ahead and clear these drawings. If you are someone who's a little bit more concerned with maybe setting up these theoretical scenarios to see what will happen to your position, if volatility were to increase or if a SPY was trading at a certain price at a certain date, what that would look like for your position. To set that graph up now, you'll want to do a few different things. So you'll want to select now the P&L Theo button here at the top. We will deselect P&L expiration, and then underneath zones, we will select Theo. And now the most important part here, especially if you're using P&L or if you're using the theoretical graph here, you'll need to pull out this right side panel on your page. So to access that, just click this arrow in the upper right corner of your screen. This will pop out our right sidebar, and then make sure you are selecting the analysis tab. So from this analysis tab, before we get into, I'll give a brief explanation on some of the different features here. If you're looking for a more in-depth demo on this, we have a great video, which I believe Christian, who's in the demo here today, he posted it on our YouTube channel. It's about 12 to 15 minutes long. So that's a super, super in-depth demo if you all are looking for something like that. But I'll just give a brief description of what you'll see here under the analysis mode. So with this analysis mode, what this is going to allow us to do here is evaluate your position at a particular date. So right now we're just evaluating for today's date. If you wanted to evaluate maybe somewhere down the line, say the 16th, you could just simply select the date there. And you could also evaluate at a particular price by checking this box here. So if you wanted to evaluate, how your position may be performing come the 16th, if SPY were to be trading at a price of 670, then you just set those metrics there.
Okay, and then so as Anthony mentioned, we have a very in-depth demo about the analysis tab. And so just keep in mind that whatever you enter here on the right side panel is what will show up in the middle of the screen. So depending on the dates that you enter, or if you change any of the volatilities, that's what will show here. And then this is how you can manage position by position risk. If you want to see, typically for a defined risk spread, you already know your risks when entering. But if you want to see the profit and loss there, you can look at it on the analysis analysis tab, or if you have a naked option or multiple options stacked on top of each other, and you just want to look at your position by position risk, this is a great place to go. And then from here, let's bring out the other account and show the positions tab. And then so we have this other account which has many positions here. And now we're going to go over some of the capital requirements and then briefly touch on the span margin, as well as going over the risk analysis mode. So in order to pull that out, we're going to go to the cap rec tab in the top right. Let me draw an arrow to that. So the cap rec tab, all the way here in the top right, this will show you where all of your requirements are coming from and the different requirements for those positions if you were to close them and what you would get back to your option buying power. Okay, and so here in the cap rec, of course, make sure you have the correct account selected. And then this will show all of the requirements for any of your given positions. And so what we want to look at first is always just this first column right here that says requirement. This is anytime you're in a margin call or something like that, this will show all of your requirements. And then you can click on this box to see what's holding the most amount of buying power, what's holding the least, what could potentially be resulting in a margin call, and stuff like that. This will also account for any futures positions, any options, stock, anything that you're trading. This will show all the capital that is held for that given position in the requirements tab. And then we have some other columns over here, your BP usage percent. We've got the initial requirement and maintenance requirement, depending on the type of position, like stock, for example, or futures. Sometimes they can have different initial versus maintenance requirements. But what you always want to pay attention to is this first box here, and that will show you the current requirement for your given position. And then from here, we can also go to the expected price range as well as your point of no return. Anthony, if you'd like to explain that.
Yeah, so with the expected price range and point of no return here, once you're on. So with the expected price range and point of no return here, once you are on the capital requirements page to see those metrics, all you have to do is select in the upper right corner here, should have a little arrow to move over. So tap that arrow in the upper right corner. And then we have a few different things that I want to bring to your attention here. So like Quentin had touched on, we have the EPR up, which stands for expected price range up. And then if we, sorry, everyone, if you just tab back here once with me, we have our EPR down, which is our expected price range down. So that is the basically the expected range that this underlying can move. So you could see it here. We have it at 40% for hood. So it's 40% down and 40% up. The final column that you'll want to pay attention to here will be the PNR. This stands for point of no return. So right now you can see our PNR is at 101%. Well, the EPRs are at 40% each. So this tells us that our PNR right now, point of no return, is outside of those expected price ranges. If your PNR is outside of those expected price ranges, you won't be concentrated in the position. The PNR, what it tells us, it's basically the point. If this stock were to move, let's just say, for example, your PNR is at 20%. If this stock were to move 20%, PNR is going to indicate the point at which your portfolio will go debit. So right now, with our PNR being outside of the EPRs, we're not concentrated in the position in any way. If our PNR were to be within those EPRs, so like I mentioned, something lesser than 40%, you would be considered concentrated in that one position. And if you're somebody who trades in a portfolio margin account, that would mean that you're being held at a requirement equal to whatever the EPR is.
Correct, yeah. And so you always want to make sure, if you're trading with high volatility stocks or you're trading with a lot of leverage, you always want to make sure that your point of no return is outside of the expected price range. And then from here, we can go to the risk analysis tab. And so this will show you your overall portfolio risk as well as each individual stock on a position by position basis. So first, before we go into the risk analysis tab, you'll want to make sure all of your positions are selected by just checking that total box right there. And so this here will select all of your positions, and then this is what we can analyze under the risk analysis tab. And then, so here, this will show you a vast risk array of all of the different positions that you have. And so I know there's a lot that's going on here. And so let's break it down. First, what we're looking at is these yellow boxes is what we want to pay attention to. If you're in a portfolio margin account, this will show your requirement. But if you're just in a Reg T or a cash account potentially, this will just show your profit and loss at the different zones. And so here, for example, we could be looking at this /CL position. And so this will show that at a negative 20% move. Here, let me put some boxes around what we're looking at here as well. We've got a negative 20% move here. And then we've also got the volatility shift that we're looking at as well. And so once we look at these two things, this volatility shift, this is just static, this 10% that we're looking at, which can also be manipulated. And then this 20%, if CL moved down 20%, this would show our given P&L. And then so from here, we can talk about how you can manipulate this to look at it on an overall account basis. And so what we can do is once you minimize some of these, this is showing all of the different positions that you have in your account. So all these, I mean, this account has a lot of positions here. It'll be showing all the different positions just based on whatever you've selected. And then to change the different percentage moves, you can either use it as none, so this won't work, and then you can use it to move the specific underlying, and then it will change the price for that underlying. Or in the top, you can go to beta weighted, and then this will show compared to SPY moving on a given position, how that will correlate to your overall P&L in your account. And so let's say we move this to SPY going, let's call it, what do you want to say here? Like down like 30% or something like that. And then so once you beta weight it to negative 30% here, oh, because it'll be up and down. I apologize. Here, let's go to up and down 30%. And then so when you look at it like this, it will take the correlation for how your portfolio would move given to SPY. And then so this would be the worst case scenario that you would see in your portfolio is what would be in the yellow box. And then if you want to shift implied volatility as well, you can change it either to percent. This is what our clearing firm and our risk team looks at is percent. So that's why it's on that default. But if you want to see how the VIX would move, for example, if you have it beta weighted, you can go to points. What would be a 20-point move in the VIX and how would your portfolio react? And then that's what you can look at there. There you go.
You wanted to maybe evaluate everything. If it were to move 25%, you can go ahead and change that to 25% there. Oops, one moment. There we go. So go ahead and change that to 25%. And that will evaluate your positions here if there were to be a 25% move in each of the particular positions. Again, that's not correlated to SPY or anything. And like Quentin had pointed out earlier, you can see on a position by position breakdown here with this not being a portfolio margin account, what these yellow boxes are going to tell us is essentially the expected profit or loss in the account if the underlying were to move this much. So you could see here on CL, for example, if there were to be a 25% move down, roughly be a loss of about $1,274. I'll go ahead and turn it back over to you here, Q.
Okay. And so let's just go over exactly what's going on here. So a lot of the positions in this account are a defined risk, but let's just look at Robinhood, for example. So we can go to the cap rec, uncheck the rest of our positions, and then we want to see the risk array of one position just to break it down a little bit more, give a simpler view. And so here we can select just Robinhood and then go to risk analysis. And then let's also deselect this butterfly that's on here as well. So we're just looking at this strangle. And then this happens to be an inverted strangle. So this is a perfect position to look at, actually see what your risks are to the upside and downside here. And so when looking, we're probably just going to switch this to none. And then here we would want to manipulate the percentages in these boxes. And so you can do this with your overall account as well as just one position. We're going to look at it for just one position just to show it in a bit of a simpler way, but then you can do this for your overall account. And so here, what we can do is we can manipulate the percentages down as well as the percentages up. So let's say we've got Robinhood going to potentially, 100% move or something like that. Then this would show the undefined risk nature of this position and shows how your position can react to the given market that we're seeing in Robinhood. And then if we wanted to look to the downside, where are our risks there? So we can switch this back to 50%, for example. And then in here, we could go downside. Well, I mean, it's not going to move down 100%. Robinhood's been flying up, right? So let's see, gravity takes effect and it goes down 50% or something like that. Our position actually won't see that much downside because it's inverted right now. And the call has so much more value than the put that all of the value coming out of that call side will actually result. And it looks like, mostly a profit or what would be a small loss all the way down to 50%. And this shows 5 different risk slides that we're looking at, the 1, 2, 3, 4, and 5. Let me put another box around that as well. So this shows the different risk slides. It shows 5. Let me draw a better box than that. It shows the different risk slides and it shows 5 different scenarios that we're looking at when you want to see your profit and loss. And that's where the risk array comes from. And then we can go back to show the entire account. I just want to go over this one more time and what the yellow box means here as well. And so we can manipulate the price here on the left-hand side. And this can show your profit and loss up and down, however you want to manipulate that at any given prices. And then we've got the 5 different columns that we're looking at for your P&L with the 5 different risk slides. And these numbers that are all in here, this will show your different profit and loss at those given levels. And then in the top right, this will work for your overall portfolio or a given symbol, whatever is selected. All the way here in the top right, that will be your profit and loss at the given position. And then so from here, what we can do is we'll clear some of these drawings. And then now we're going to go look at the entire account to show how you can get back to that full account view and stress test your overall portfolio. So we'll go back to CapRec and then click on this totals button here. And then this will make sure that all of your positions are selected. And then once all the positions are selected, we can go to where it says risk analysis. And then within the risk analysis, we can go and edit this however we would like. We can choose to beta weight it to SPY, and then we could talk about, a 40% down move, something like that, how it would look in the overall account. And then whatever is up here, I guess this account must be long volatility and really short the market. No loss at a 40% down move. Of course, that may not actually be the case. But when looking at a realistic portfolio, it may look something more like, where's that yellow box hovering over? Okay, SPY just does whatever it wants when SPY is moving. But let's get this back to none, and then we could see what the actual positions are being held at here. And then so when we're looking at this yellow box here, that is your worst case scenario. And so in this case, it looks like it would be a 12% up move in SPY. And so that's what the overall risk array is looking at. And then whenever you want to look at all these numbers, all this red and green, all it's showing is your profit and loss for that given position on the left-hand side at that given risk slide that's listed on the top. And then so from here, that's the risk analysis tab. And then if you have any questions on this, please always feel free to reach out to us. That you can reach us via email or give us a call as well, or a live chat through the website too. And then now we can touch on some of the span scenarios, talk about span margin and how that works. So when we click on span scenarios up here in the top left, all of this will show you just where your margin requirements are coming from for your given position. And so there's 16 different scenarios that the span margin from the CME goes through. And so right here, scenario one is just unchanged and volatility up. This is what all of this means. And then scenario two is unchanged and volatility down. What a lot of people will be held at is like these later scenarios. And so, like this, for example, scenario 16, let's just describe what this goes over here because you're saying like minus 300%, that doesn't make any sense. How does that work? And so the minus 300% from scenario 16 is coming from the minus 300% of the given expected move for that day. And then up just stands for volatility up. And the profit and loss your position would see from something like that happening is what your requirement would be. And this is our best look. It's the span margin system. And then this is how your requirements are calculated for any futures positions. And then so here, for example, we're being held to span scenario 14. And so that's just because these are defined risk positions, and then span scenarios 15 and 16 just wouldn't make much sense. And so that's why you're being held at span scenario 14 here, where it's just 100% down the expected move of that given day, and then volatility going down just because those long options won't act as much of a hedge if volatility is down. Okay. And then from here, we can just talk about some general risks that we see a lot when people are trading. And so, one of the biggest risks that we see a lot on the desk here is expiration risk. People holding positions until assignment. There's a lot we see with any equity options or futures options. If you're trading something that's cash settled, like SPX, then there's not really much expiration risk. But if you're trading something like SPY or /ES, where the assignment goes to actual shares or outright futures contracts in the latter, then you would see expiration risk. And so, what this means is that if you're doing a vertical spread, even though that's defined risk, if the underlying closes in between that vertical spread, that could result in exercise and assignment without the offset of the short or long leg to offset that transaction and result in a flat account. And so, even if you're making a debit spread, let's say a call spread that it looks like it's about to expire in the money, but then it could potentially go in between your short and long strike, that could result in assignment without exercise, or that could result in exercise without assignment, and then you could be long 100 shares of stock that you don't intend. So for expiration risk, unless you're trading something that's cash settled, typically you would want to close out a position early. And then we also see a lot of early assignment and dividend assignment risk. And so for that, Anthony, would you want to go over the dividend risk and early assignment risk and how that works?
Absolutely here, Q. So with the dividend risk and early assignment risk here, there's a couple things that you'll want to look out for. So when it comes to the dividend risk here, so what are we talking about when we refer to dividend risk, right? Typically, that's going to refer to calls. So if you're short calls, whether it be naked short or if you're short calls as part of a spread, and there's an upcoming dividend announcement and there's an upcoming dividend ex-dividend date for a particular underlying that you're trading. Well, those calls, they have some dividend risk associated with them. So a couple things you'll want to look out for when it comes to dividend risk is one, you want to see the amount of the expected dividend. So if the corresponding put, let's just say in this example, you are maybe short a 100 strike call.
Here, let's take a look at
Or we could use, yeah, we'll use something here in the options chain for it. So let's just say maybe we are short a 649 strike call here. The dividend payment here on SPY is expected to be like $1. we'll say. So what we'll do to determine our risk when it comes to the dividend risk here is look at the price of the corresponding put. So we're short the 649 call. We could see the 649 puts are trading at about 508 by $5.10. Well, with an expected dividend payment of $1, if that price of the corresponding put is greater than the expected dividend payment, then your dividend risk is considered to be low. If the price of the corresponding put is less than the expected dividend payment, your dividend risk is considered to be high. So that's one thing you'll want to look out for when it comes to those dividend risk situations. And we typically do send you an email as well notifying you of this. So the other thing I wanted to cover here would have been the early assignment risk. When it comes to early assignment, there's a couple things that you'll want to look at. First of all, it would obviously be revolving around short positions because you're not in control of those short options, whether it be short calls or short puts. So there's a couple things that we want to look at here when it comes to determining whether or not early assignment is likely. One, is that short option in the money? If that short option is in the money, what you'll want to do here is actually take a look at the extrinsic value associated with that option. So to see that extrinsic value from the options table here, we'll just use an example right here. So maybe we have a short 645 call here on SPY, and we want to determine how likely it is for us to get assigned on that early. Well, at this point, we could see obviously the options in the money. So now we'll turn and take a look at the extrinsic value associated with it. The extrinsic value, we can access that from the table mode here. If we click on this customizable column here toward the top left, you'll see we already have extrinsic value shown. If it's not shown for you, I would suggest clicking on one of these customizable columns, and then from the drop-down list, click on the EXT option. So this will show the extrinsic value associated with the option, or the time value associated with the option. Generally with this, I mean, we get these calls all the time. I typically see it as extrinsic value is getting, less than 50 cents, then the likelihood increases. But that it should be noted that you can technically get assigned at any time, although it may not make much sense to you. The person that's long that option ultimately is the one who decides whether or not you get assigned early.
Yes, and so something I like to look at as well, with SPY, this is actually a great example. If you're short, like let's talk about like these calls that are super far in the money. If you're short these calls and your put side that you're looking at is 17 cents, if the value of these puts is less than the spread between the bid and ask, the person who's long may not be able to get out at a fair value, and so that could result in early assignment risk. And then, so another thing that I really want to talk about is just like your overall portfolio theta and how that actually poses risk as well. And so, when it comes to your overall theta that we're looking at here, our theta is 77. That's not a very high theta, but a lot of people are like, I want that time decay every single day. So I'm going to juice my theta as high as I possibly can. But what comes with theta, the reason you're getting paid to take on all that risk is because there's a lot of price risk that's involved with the theta. So if we're looking at a straddle, for example, here we can pull up a straddle in SPY. So let's just look at this straddle for example purposes. And then we see our theta here is $21. And so the reason our theta is so high compared to something like a strangle. So here for the straddle, let's keep this in mind. The theta is $21. And then if we go to a strangle, that's further out of the money. As we decrease it more and more, decrease the probabilities, we'll see that the theta keeps getting lower and lower by a few dollars per day. Because we're 73 days out, it's not going to change so much. But as we keep widening it out, it's going to get lower and lower. But then once we move it back to the straddle, we can click and drag it here. The reason our theta increases is because there's a lot more price risk involved. And so that's why you're getting paid each day. And so you may want to consider that before juicing your theta as much as you can when doing these positions versus, selling the higher probability strangle that you may be looking for. You may want high theta, but also keep in mind that involves a lot of price risk as well. And then just lastly, another thing we would like to go over before we open it to Q&A is that talking about just like over leveraging yourself and creating too large of a position. Something that we see on the desk a lot is just because you have a certain assumption on a stock or the overall market does not mean that you need to over leverage your account to capitalize it. There's nothing wrong with taking a shot, taking a directional shot, or taking a shot on volatility, something like that. But that doesn't mean that you need to over leverage your account to be able to capitalize on that position. And Anthony, if there's anything you want to add on that.
I think you touched on it, my friend. So
Okay. And so just before we head out here, every trade comes with risk, and the point is not to necessarily avoid the risk, but it's to manage it in a way that can keep us trading. The key is to understand how that risk fits into your overall portfolio. That might mean, watching concentration, paying attention to buying power, or using metrics like the Greeks to guide our decisions. And when you're swinging for the fences or going for base hits, risk is what lets us play the game, but risk management is what allows us to keep playing. And so with that, let's take a look at some of the Q&A in the chat. Anthony, is there anything that you want to go over here?
So we have somebody asking here, how do you know if you have too much in one position? In that case, I mean, ultimately, your risk, what side of the market you're playing, whether you want to be more positive delta, negative delta, that's going to be completely up to you. But one important thing that you can note is going to be those net deltas at the top of the platform, as well as the net deltas that you're seeing on your positions page. So if we just go back to the positions page here quickly, you can see that's going to be this column here. We have ours weighted to SPY right now, but this is going to show you your overall delta for a particular position. So that's one thing that you can use.
Yeah, I mean that's a great question, right? That's the question we're all looking to answer, how do you know whether or not you have too much in a position? I would say as long as your risk tolerance, it doesn't keep you up at night, the position, that's fine. There's nothing wrong with taking a shot. But you just want to make sure that, when you look at your profit and loss, like is your account going to go debit from a small move or from an expected move that we're seeing? You would just want to make sure that you have the appetite for that risk, and there's absolutely nothing wrong with having a large risk appetite. But you just want to make sure that when you're looking at it, that you can see, do I feel comfortable taking this potential loss for the amount of gain that I'm looking for? And then what do you consider a healthy buying power ratio? That's a great question. I mean, it's really tough to say, and it depends the different types of strategies that you're trading. Like if you're trading futures options, for example, you may not want to go over like 15 or 30%, something like that. And then, but if you're trading like just defined risk spreads, then, you might want to up the buying power a little bit higher. Or if you're trading naked options, you might want to keep the buying power higher as well. It depends on the different types of positions. If you're mixing all of them, it can also depend on your trading style. If you're trading, selling options like a lot of our customers do, that could be something that when volatility is low, you want to keep your size smaller. You can still keep positions on, let the probabilities work out in your favor, but you may want to keep the position small because then when a volatility eventually expands, that could result in higher losses, and you may not be able to pounce when you really want to once volatility is high. That's something I realized a lot during April when the market went down a lot. You want to make sure that you still have enough powder on the side to where you can pounce when volatility is really high and you're not over leveraging yourself while volatility is still low. And then is there a way to see gamma exposure on the platform? Of course, I would say overall gamma exposure doesn't that's not something to really analyze too much, unless you have a really large account. But if you have an account like we have here, like 25, $30,000, your overall gamma exposure won't be that much, but it would just be to go into the header detail within the settings, and then you could add gamma. We'll add it with the be how be better if I knew how to use a computer. We'll add it right next to our other Greeks here. And then this will show our overall gamma exposure. Typically, your 1 day price movement may not be so big if you have a smaller account to look at your overall gamma, but that's definitely something that you can analyze with a larger account. Typically, I would just look at the theta. I mean, you could look at the gamma as well, but typically looking at the theta is a really good place to start, making sure, you're thinking like, wow, how am I getting, obviously $55 may not be that much theta here, but wow, how am I getting these thousands of dollars worth of theta? That's because your price exposure could be really high. And then, yeah, how to pull up the risk analysis tab again. Yeah, let's go over that. And so what you want to do is first, you want to go to the cap rec here in the top right. And then also, if you're on the web platform, it'll be really similar. It will just be right here next to this beta weighted SPY on the positions tab. But you want to go to positions and then cap rec. And then once we open the cap rec window, we'll be able to go from here. And then one of the tabs on the top is risk analysis. Make sure you have any of your given positions selected, and then you can go to risk analysis, and then this will show you the overall risk array for your account or whatever positions that you have selected. And then another thing I would like to mention about the risk analysis tab as well, if you're analyzing any naked positions here, we could put on a little strangle and SPY just to show an example here. Let's do it, just different expiration. So we can just sell this strangle, for example. Just get filled right away. And then from here, what we can do is we can add order legs. This is something that's super interesting. So if you want to see how a position will protect you and how a hedge will protect you, then you can pull up an order to, let's say we think the market's going to roar up. There's some sort of economic news. We want to buy a call and see how that will affect us. So we can populate an order to buy a call. And then from here, we can go back to the risk analysis tab. And then we can click on this button in the top right that says add order legs. And so I'll draw an arrow to that. We'll click on this button in the top right that says add order legs. And then when we click on that, that will add the call that we haven't placed it yet, but the order ticket that we pulled up, that will add that here. And then if we think, the market's going to go up 10% or something like that within the next week, we can look at, because you can also change the date here in the top right, then this will show how this will actually protect us. And then it will turn into an overall profit for the whole underlying. And then so we can see that here. Let me draw a better. Got to work on these drawing tools. So we can see that here under the 10% column, it will show an actual profit because of our hedge there. And so this is not necessarily the position you may be looking to hedge here, just a regular one lot strangle. But depending on the positions you're looking to hedge, this is something that you can add. You can take your order ticket and then add it to the overall risk in your account. So let's say you're trading a bigger account and you want to hedge with futures or futures options. This is something that you can look at just by hitting add order legs. And then, of course, you can hit X on the order legs to then delete the position and then just look at the current risk that you have.